Hi everyone, so today we're going to be doing a new stock analysis video on Wingstop. I have Dom here and he's going to first off cover the company analysis and we're going to see the financials for it afterwards.
All right, let me share my screen. Let me
All
know
right.
if you can see that.
Yeah, perfect.
Cool. Yeah, so today we're talking about Wingstop. So basically, they are a fast food restaurant that basically sells anything to do with chicken. So think chicken wings, chicken tenders, chicken sandwiches, anything chicken related, it's probably on their menu. A couple of things I wanted to note about them is that they have been a really quickly growing company. They've grown quite a bit since they first started, and that's partially helpful for their success, but also we'll find out later, it might also impact them negatively. But I don't want to take too much away from Matt's portion. But I do want to note that most of their income actually comes from franchising slash franchisee fees, advertising, things like that. Because they do have their own restaurants per se, but the vast majority of them, I think it was 98%, it
Yep.
said in the article, or
Yeah.
somewhere around there, was franchised. And so that way they don't actually have to monitor those restaurants and things like that. The franchisee does everything, and they just collect their fees and all that. Um, there was something else I wanted to mention in the article. Um, oh, that the even though they do get all their money, well, not say all, but a good majority of their money from their franchisees and stuff, it's ending up having a problem with their debt, as we'll talk about later, because they're having to figure out how to restructure their debt, even though they have decent cash flow, because of having all the franchisees so quickly and growing so quickly. And so that's kind of what I want to segue into Matt's part now, just to kind of get a little precursor to it.
All right, perfect. Thank you, Dom. I appreciate it.
Thank you.
All right, so yes, as Dom was saying, it is a good company and we're first going to take a look at the earnings to see really how that's doing. And their earnings came out, or their most recent earnings was Q2, and that came out 2025, or excuse me, July 30th of 2025. And as you could see here, it was very much okay. So you have Wingstop total revenue increased 12% year over year, 174.3 million, beating the consensus estimate of 172.6 million. EPS came in at $1 exact. This beat estimates of 88 cents per share. So really good overall. Domestic same-store sales growth, which you have to be a little bit careful of, declined by 1.9% for the quarter. This is compared to 28.7% growth in the same quarter of the previous year. And just keep in mind, if people are wondering, there has been a sell-off in the stock. Really, it hasn't moved, and it has been selling off year to date because of the declines in all of these revenues and things like that from last year, because they had a great year last year. New restaurants, Wingstop opened 129 new restaurants globally, contributing to a 19.8 unit growth rate. Also good, and the board of directors increased their quarterly dividend. So yeah, here's the more of their international expansion. Wingstop is also growing presence in international markets with record set openings in Australia and Paris, France, and plans to enter new markets like Italy and the Netherlands. So it seems like a big portion of their growth is going to be in international companies or countries overall. And this is going to segue really into, I think, the next part, which is we're going to look at the previous free cash flow, which is pretty good, I would say. 2021, 20 million. Next is 55 million. So it more than doubled, which is great to see. And the free cash flow, again, is going to grow, and we'll see that in a second. But just to go onto the future growth here, which I'm going to pull out. So like I said, free cash flow good. Now we have 55 million, like I said, and the next 3 years is going to be 190 million. So that's about a triple, a little bit more than a triple. Great. Nothing to complain about here. This is the thing that is a little bit cautious. I'm a little bit cautious about is the debt to equity history analysis, the financial health of the company, more specifically. So you have a very interesting scenario here. And Dom and I haven't really covered a company like this on the channel yet. So we have a lot of debt, it's a mess. Like cash is positive, so the cash is good, and then the debt is higher, and then the equity is negative. So then you're going to have something called negative shareholders equity, right? Which is a more serious situation than a high debt level. And then you have a little blurb here of what explain that means when there's more liabilities than there are assets for the company, right? So I use Google Gemini next to see what's really going on with the company. And it seems to me that specifically with Wingstop scenario is that they're using a lot of debt to finance their dividends, their regular dividend payments, their share repurchases. For example, in 2023, they had a $125 million share repurchase program with a dividend increase as well. You also have debt funded capital returns. Wingstop has consistently taken out additional debt through securitized financing transactions to fund these dividend payouts and share repurchases, increases liability without a corresponding increase in its assets. And then asset light business models like Dom was speaking about before, because Wingstop franchises 90% of its restaurants, it does not need to own most of the physical assets that would typically be held on a traditional company's balance sheet. This means its asset base is relatively small to the amount of debt it can comfortably carry due to strong and stable franchise fee or strong cash flows, right? Which is really good to see, but you have to be also a bit cautious about it and why negative equity isn't necessarily a red flag for Wingstop. The company's franchise model generates highly reliable cash flow. So obviously banks, when they go to a bank to get out a loan, they're going to see that they are a reliable business that gains a certain amount of money per year. And banks are okay with it. So they could, for not forever, but they could increase their debt load each year and be perfectly fine. Now, so you have really they're making from royalties and advertising fees like Dom said too. And this allows it to comfortably service its debt obligations. Valued on cash flow, not book value, because Wingstop value is derived from its ability to generate free cash rather than its physical assets. Investors focus on cash flow metrics like free cash flow and EBITDA, not the negative book value. And then there's financial engineering. The negative equity is a result of deliberate financial strategies designed to maximize returns to shareholders by using cheap debt instead of the company's own cash, as long as the company can manage its debt payments. So obviously there's a bit of a risk and you have to be careful of it. I tend to stay away from companies like this in general, but we're going to see if it's overvalued, undervalued next. And now if you could see here, it's going to be still 18% overvalued. It's going to be overvalued however you look at it. If we use Wall Street forecasts, Wall Street's going to be even worse, 46% overvalued. So really overvalued. And I do actually agree with this DCF rather than what Tipranks is going to say, because Tipranks is going to say that it's a strong buy, 16 buys, 5 holds. And I get where they're coming from. I get the premise of it because don't get me wrong, the free cash flow, future free cash flow growth is incredible, like 3.5x, 3x on their free cash flow in the next 3 years. That's really, really good. But the problem is that still based on its growth right now, because it's only growing about 12% a year, it's still overvalued. And so I don't really agree with Tipranks on this. And to be on the safe side, I would want to check Q3 just to go over it with Dom again. But Dom, is there anything else you wanted to add?
I don't know if I said it originally in my portion, but I did want to
Yeah.
remind them that because it is growing so fast, part of a problem with this is also potential cannibalization of franchisee
Good point.
restaurants
Yeah.
because it's not always like checked like in terms of like market share and like distance to other buildings. Like, it would be, good for both businesses to still get a good amount of business. Sometimes it can be close enough where they're really just taking each other's business at the same time, which obviously at the end of the day, like it still gets a sale for the owners of Wingstop, but both franchisees suffer from each other from being so close, which could end up being a bigger issue too if Wingstop keeps growing really quickly because obviously, like I said, like you still get the revenue for being the owner, but the franchisees will eventually have to start closing if they can't keep their doors open because they're
Right.
taking from each other, which could be an issue.
Right. Exactly. Yep. I totally agree. Yeah. Okay. All right. Well, Dom, I appreciate it. Thank you.
No, thank you.